Hello everyone, today we'll be looking into the basic accounting concepts. So, we all know we play cricket, we love cricket and we enjoy cricket. So, before we understand cricket orders, we have to understand the law, we have to understand the principles, have to understand how to play cricket, how to understand the cricket, what does a batsman do, what does a bowler do, what does an umpire give, when does an umpire give out, when does an umpire give six or four. We have to understand each and everything. So these are the assumptions or these are the guidelines which we understand when we play cricket. So you might be liking to do ball, you might liking to bat as well as. So why you might like to bat, you like to hit six or four, you might understand how to hit a six or four. For a bowler, he might understand how to take a wickets, how to do an LPW. So these are the fundamental backgrounds. So similar to cricket, it's like a accounts. So before starting to make books of accounts or recording transactions, we have to understand how this accounting system works. So there are certain concepts, certain principles, certain assumptions which as professionals has been made. So this has to be understood in a very great way so that you can apply this in the accounting concepts on accounting transaction and accounting entries. Before going into that, we have to understand that these concepts are not only applicable in today's scenario but all the accounting entries or all the accounting transactions for a big entities or small entities, it applies to same. It an universal rule like a cricket where LPW means out is out. So here is also similarity same is the same. So we have a first concept which is a business entity concept. So we all know that we like India Pakistan match very much, and we always think that India should win. So let's say there's a scenario where India has to chase some runs and Virat Kohli is batting and he helps down to score a thrilling match and India wins by good amount of run chase. Now you might be saying that India has won. India's won the match because Virat has contributed. It doesn't say that the match was between Pakistan versus Virat. It was Pakistan versus India. Virat helped India to win. So similarly here, a owner helps his business to grow. So what does this mean? So business and owner are two different persons. Two different persons. What happens when two different persons come together? So let's say here in the example of Mukesh Ambani and Reliance. So Mukesh Ambani will help his Reliance to grow his business. Okay, so we might say that one thing that Mukesh Ambani is a promoter of the business, he is the owner of the business. Yes, but as per business entity concept, when an owner puts his capital in a business, from an accounting perspective, a business is an artificial person. What is doing by artificial person? It's like a person which is acts like a person in a real life scenario. So from business perspective, we see that if we are getting cash, it is our cash and it's a liability that we have to pay back to our owner. That's why we do cash account to capital account in our journal entry, or we say capital is the owner's money. So cash is an asset for us. So this are a concept which says that business and owner are two different entities, similar to India and Indian team are two different entities. So Indian teams plays for India, not that Indian team versus Pakistan. It is India versus Pakistan, and that's why we say Virat contributed to India's match. It doesn't say that Virat has led the whole match to win to him. Virat has contributed to win this match. Contribution means it is at two different parts. This is what business entity concept states. Money measurement concept. The money measurement concept is very simple. So let's assume you're going to cricket coaching. So you see many people are buying so many expensive bats. There'll be thousands of bats like SG, MRF, C8. Okay, but we won't be seeing number of bats, we'll be seeing the value of the bat. You might see the number of bat may cost 2 to 3 lakhs rupees, a SG bat may cost 2 to 3 lakhs. We might not see how much number of bats are there, we see the value of the bats. It's because as per monetary effect. So money measurement concept is also a similar thing. So what happens is, in a business, we don't see that we have number of acre of land, we don't see number of factory, we don't see number of assets we have. We see the monetary value of assets. And another aspect of money measurement concept is, we don't record a manager's skill or expertise in that. So management have a 20 years of experience in the business, but we can't record in a monetary value. It's similarly like you are having love and affection to your parents, which can't be expressed in a money value. This is how money measurement concept works here. So this helps us to understand that anything which has money or a monetary effect in a transaction, it has to be recorded in the books of accounts. Going concern concept. The going concern concept is a very interesting concept. So we know all Ratan Tata here. It's one of the great, it's the legend who has helped many people. So you might be wondering, if Ratan Tata is passed away, how a business entity runs. So always in accounting concept, we assume that a business, an entity will do his business in future and future and future. So let's say the classic example of RCB. So we waited for 18 years, literally 18 years, that Virat Kohli and the team could carry the cup. So every year we used to think that next year RCB would win, next year RCB would win, and next year RCB would win. So we waited so many times. So we forecasted that in future that they are going to win in future. Same happens in a going concern concept. So we see that business is going to carry forward in future without getting disrupted. So you might say Ratan Tata's person, how Tata is running. There are multiple owners in the business. So in a business, it doesn't stay only one entity, one person. It have multiple persons shareholders stake in that. That's why the business is keep on running till now. This is what is going concern concept. So next is very interesting concept is a revenue recognition concept. So in this concept, we have to record when we are doing a sale transaction. So let's say you want to see a series called Friends, which is one of the most popular series which I have been seeing for such a long time. So you want to see a Friends. Now you see you don't have Netflix subscription. So you go to the Netflix website and see you have various pack. You select a 12-month pack, which is something 1,200 rupees, let's say. Now you might be wondering that I want to see Netflix now, but they collected 12 months money in advance. Now what they're going to do with so much money at one time? Now as per accounting concept, we might only require to record a transaction what happens at that day. Okay, so you have paid 1,200 for 12 months. So if we divide per month, we're gonna pay 100 rupees. Correct? So this 100 rupees is going to be recorded in each and every month of in the books of accounts. So until that 12 months get completed, this 100 rupees is going to repeat in their books. So they're not going to record all the 1,200 rupees at one go. So if we simplify, at the end of the day we say that we have to see when the transaction is happening and then what is the time period of the transaction. If it's 12 months or 9 months, you have to divide it by 9 or 12 months or number of months it has. Then only you can record it as a transaction, because if you record all at once, it's gonna show as a increase in the sales and gonna impact the financial statement, and it might deceive all the stakeholders in the business environment. And yeah, these are the basic important concepts. So hope you liked it, and probably I would be have a question for you, that the thinking studio and me, what concept is going to apply between thinking studio and me. Just let me know. Bye bye. Thank you.